Welcome back to the Daily Crypto Roundup. If you're listening right now, hit that follow button and drop a 5-star rating. It takes 2 seconds and it genuinely helps push this show further up the charts. Every tap helps more people find the podcast, and that keeps us here every single day breaking down the stories that actually move the market. In today's extended episode, we're going deep, because the past week wasn't just noise, it was a reset. We're unpacking how the market bounced back after the biggest leverage flush in history. What really happened during that $19 billion liquidation event? Why Nigel Farage just became the loudest political voice for crypto in the UK? And what's going on behind those insider trading accusations that popped up after the US tariff shock? This is a full-length special, so sit back, get comfortable, and let's get started with the top 10 coins by market cap. Bitcoin trades at roughly $114,670, edging higher after that weekend surge. The key phrase here is stability returned. Order books are calm again, spreads have tightened, and volume is picking back up. The bulls haven't gone all in, but they're no longer hiding either. ETH sits around $4,169, up just over 1% on the session. You can feel confidence creeping back in as staking deposits resume and Layer 2 activity keeps growing. After the chaos of last week, ETH's ability to hold above 4,000 quietly says more about the network's health than any headline can. Solana trades near $199, just under the 200 line, with a daily volume spike of almost 30% as retail traders came back to the table. Every time Solana gets written off, it refuses to stay down, and this rebound is no different. XRP's sitting close to $2.59, retracing almost the entire tariff-driven dip. Its network activity, particularly cross-border settlement volume, remains strong, a good sign that fundamentals, not hype, are holding it up. Binance Coin is hovering at roughly $1,280. It hasn't made headlines, but quietly, its burn schedule and exchange usage keep shrinking supply. Cardano trades around 71 cents, Avalanche just shy of $23, Dogecoin back over 21 cents after a rough patch, Polkadot roughly 33 cents. So, that's where we are right now. The board's reset, prices are holding, and the noise has faded. What we're left with is the reality of a market that's self-corrected. The rebound didn't come from thin air, it came from structure. Bitcoin's rebound started the moment leverage died. Once the forced sellers were gone, spot buyers, the ones with real conviction, stepped back in. Analysts across the board have pointed out that wallets holding more than 10 Bitcoin saw a measurable uptick in accumulation over the weekend. That's long-term capital. The same pattern shows up on-chain for ETH's validators. Staking deposits continued even as prices were still red. When you see investors add to staking positions while headlines scream crash, that's confidence, not luck. Think of this recovery as a 3-stage story: fear, flush, foundation. Fear hit first when the tariff news broke. The flush came as over-leveraged traders were liquidated across every major exchange. Then, the foundation returned when patient capital started buying the dip. This is crypto's rinse and repeat cycle, and it's playing out exactly the way veterans expected. When you zoom into Bitcoin's chart, you can see how quickly the panic turned. The drop from 120K down to just above 105K looked catastrophic on paper. But the recovery candles were faster, larger, and carried heavier volume. That's not retail noise. That's institutional demand stepping in. Derivatives data backs it up. Open interest collapsed during the crash and then rebuilt gradually, not impulsively. The average leverage ratio is now the lowest it's been since early 2024. That's how proper bases form. Slow, measured, sustainable. For ETH, the signals are even cleaner. Gas fees spiked temporarily during the sell-off. That's expected. But within 24 hours, they normalized. Layer 2 rollups like Arbitrum and Optimism kept processing transactions at record speed, meaning user engagement didn't evaporate. It's rare to see network activity hold steady while the price drops 20%, but that's exactly what happened. It tells you people were still using Ethereum, not fleeing it. The next factor to look at is derivatives positioning. Before the crash, perpetual funding rates were aggressively positive. Everyone was long. Once the cascade began, Funding flipped negative across major venues and stayed there for 48 hours. Negative funding means short traders were paying longs, a clear sign of overcrowded pessimism. Historically, when funding stays negative for more than a day and a half while spot volume increases, markets rally. And that's what we got. Now we need to understand why the liquidation wave was so violent, because this is the heart of the story that shaped everything. It wasn't just panic, it was mechanics. The $19 billion wipeout started when the news of a 100% tariff on Chinese tech exports hit the wires. Traders were caught on the wrong side of leverage, and the dominoes fell faster than most people could refresh their screens. Across Binance, Bybit, and OKX combined, over $7 billion in Bitcoin longs were forcibly closed. Another $4 billion came from ETH, and the rest was spread across Solana, XRP, and other high-beta alts. It was the largest single-day liquidation event in crypto history, beating even the May 2021 crash. But here's the irony. It might have been the healthiest event of the year. Leverage amplifies both directions. It fuels rallies, but it also magnifies panic. Once the leverage is gone, what's left is real demand. That's exactly what the market has now. Funding's normalized, margin debt's lower, and traders are finally respecting risk again. In other words, the weekend's pain built the foundation for the next leg up. Every serious investor knows that flushes like this separate speculation from conviction. When the leverage noise clears, genuine accumulation starts. Now that you've got the context, we can start looking at what happened next. How the market transitioned from chaos back to order, how institutional flows kept coming despite the headlines, and how political voices like Nigel Farage started shaping the next phase of sentiment. After the forced selling cleared, the mood changed almost overnight. Analysts on CNBC and Bloomberg called it the most orderly recovery they'd seen since the post-FTX rebound. Bitcoin climbed back above 100,000 within hours. ETH reclaimed 4,000. And by Monday morning, traders were already debating whether the bottom was in. But the bigger story wasn't the bounce. It was who bought the bounce. Wallet analysis from Glassnode showed that more than 35,000 Bitcoin moved into long-term storage addresses between Friday and Monday, the largest three-day net inflow to cold wallets since April. That's not retail. That's whales, desks, and funds quietly buying fear. In simple terms, smart money turned the crash into a discount sale. On the institutional side, ETFs flows told the same story. Despite the sell-off, spot Bitcoin and ETH funds recorded a combined $600 million net inflow across the week. Fidelity's product actually led BlackRock for the first time in months, suggesting retail brokers and retirement accounts are picking up exposure through more traditional channels. That's the tell. People who can't stomach leverage still want crypto exposure, and they're using regulated vehicles to get it. So where does that leave us? Structurally healthier, leaner, and less levered. The funding reset gives the market breathing room. Volatility is still high, but it's the kind of healthy volatility that shakes traders awake without killing confidence. And that's where politics entered the frame. Over the weekend, while traders were licking wounds, Nigel Farage stood on stage at the Digital Assets Summit in London and said, "I am your champion." In one sentence, he turned a niche event into international news. For years, British crypto advocates have begged for recognition. They've asked for tax clarity, for open-minded regulation, for anything that signals the government understands this industry isn't going away. Farage gave them that, or at least the soundbite version of it. He proposed a national Bitcoin reserve, a flat 10% capital gains tax on crypto profits, and an outright rejection of a central bank digital currency. He framed crypto not as rebellion, but as innovation, calling it a chance for Britain to reclaim financial leadership after Brexit. The crowd loved it. Markets noticed. Now, of course, speeches don't make policy, but they do move perception. The moment a politician connects digital assets with economic competitiveness instead of criminal risk, capital pays attention. London's always been the city of financial reinvention. From Eurobonds in the 60s to Forex dominance in the 80s to fintech in the 2000s. Crypto could be its next act. If you're wondering why this matters to traders in New York or Singapore, remember that narrative drives allocation. When one G7 figure embraces crypto rhetoric, others feel pressure to follow. It reframes regulation from punishment to participation. That's why we're seeing renewed institutional chatter about London as a hub for tokenized markets and custody services. JP Morgan's Onyx desk already runs settlement trials through the UK. Fidelity Digital Assets has London compliance teams expanding. Those things don't happen in a vacuum. They happen because someone in politics signals, "You're welcome here." Meanwhile, back in the charts, Bitcoin's daily candles tell the other side of that optimism. The range between 112,000 and 116,000 has turned into a proper accumulation zone. Traders call it the boredom band, that period when the emotional extremes fade and patience pays. When funding rates hover near zero and volume consolidates, you're in the build-up before the next leg. ETH's doing something similar. Its range between 4,000 and 420 looks tight, but under the hood, Layer 2 volume keeps setting records. Base, Arbitrum, and Optimism together processed more transactions last week than Ethereum's mainnet did in all of 2022. That means developers aren't waiting for perfect prices, they're building through the noise. For altcoins, Solana and Avalanche have quietly become the liquidity playgrounds again. Meme coins are back, NFTs are testing higher floor prices, and DeFi volumes are ticking up. It feels like the early innings of another rotation, not mania, but curiosity. Before we move deeper, a quick word from the people who keep your portfolio safe. Protect your stack with a Ledger wallet. Keep your keys offline, your coins under your control, and your future secure. There's a link in the description. Grab one if you haven't yet. Now let's get back to the story. The question everyone's asking now is whether last week's chaos was an accident of timing or something more coordinated. That's where the insider trading allegations come in. On-chain sleuths spotted a wallet that opened massive short positions on Bitcoin and Ethereum roughly 30 minutes before the US tariff announcement. The positions were perfect, the kind of trades you'd only make if you already knew the market was about to tank. Whoever it was walked away with tens of millions in profit. That timing was too clean to ignore. Exchanges rushed to deny any leaks. Binance said the trader used public information and standard hedging. But traders on X didn't buy it. Screenshots of the transactions circulated within hours, and conspiracy theories multiplied. Some claimed it was a government insider. Others thought it was a high-frequency desk with algorithmic access to Washington news feeds. Here's the truth. We don't know. But the fact that the industry's first instinct was suspicion shows how fragile trust still is. Crypto was built on transparency. Yet, when volatility hits, even the most transparent ledger can't protect perception. The phrase, "someone always knows," still hangs over every chart. Regulators will investigate. They always do. The CFTC has already asked a handful of exchanges for trade logs around that window, and the SEC's enforcement division is rumored to be reviewing communications between certain market data firms and derivatives desks. If anything comes of it, expect new reporting requirements for large leveraged positions. The crypto version of stock market Form 13Fs. Ironically, scandals like this tend to strengthen the ecosystem long-term. They accelerate the creation of clearer rules. They force exchanges to prove fairness. They bring adult supervision into rooms that used to thrive on chaos. We've seen it before. Mt. Gox taught custody. FTX taught transparency. Terra taught stability. This could end up teaching accountability. What matters for listeners right now is that none of this changes the macro trend. Institutional interest isn't fading, it's deepening. ETF flows continue to set records. Long-term holder supply keeps rising. Retail sentiment, measured by Google search trends, has turned neutral from fearful. That's exactly what you want after a washout. Indifference, not euphoria. If you zoom out, the narrative forming is simple. Bitcoin and ETH are behaving like macro assets, not speculative toys. They sold off on tariffs like equities did, then stabilized when equities did. That correlation tells you institutional traders are running crypto in the same models as everything else. It's part of the system now. So where do we go from here? The next catalyst will be data. CPI prints, ETF inflow numbers, and any whisper of monetary policy shifts. If inflation softens, yields drop, and risk appetite returns, crypto stands to benefit first because it's still the purest expression of liquidity in motion. From a technical view, Bitcoin needs to close a weekly candle above 116,000 to signal continuation. Ethereum's target sits around 4,500 for the same reason. Reclaim and hold that level, and the conversation turns from rebound to resumption. As we head into the new week, traders will also be watching the altcoin rotation. Historically, when Bitcoin stabilizes and dominance peaks, capital leaks into high-conviction Layer 1s and DeFi plays. Solana and Avalanche are already showing those early signs. If that rotation continues without excessive leverage, it confirms this isn't just a relief rally. It's the groundwork for the next cycle. In other words, the market has been stress-tested, politically, mechanically, psychologically, and it's still standing. That resilience is the real headline. And as always, keep perspective. Volatility is the price of admission for outsized returns. The weekend reminded everyone that discipline beats bravado, custody beats convenience, and patience beats panic. To the traders listening on the morning commute, the long-term holders tuning in during gym sessions, and the new listeners who found this show through a friend, thanks for spending part of your day here. This podcast only grows because of you. If today's episode helped you make sense of the noise, do 2 quick things. Hit follow on Spotify and leave that 5-star rating. It takes seconds, but it means a lot. We'll be back tomorrow with the daily rundown, fresh ETFs flow numbers, new altcoin rotations, and updates from both Washington and London as the policy conversation heats up. And of course, we'll keep tracking how Bitcoin and ETH react as this consolidation tightens. Until then, keep your head clear, your keys secure, and your outlook long-term. Bitcoin steady, institutions accumulating, builders building. That's not chaos anymore. That's structure. Thanks for listening, and as always, we'll see you at the top.